This is the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Any postings and or social media content are the views of the advisor and do not necessarily reflect BMO's position or viewpoint. The information herein is for Canadian residents only and does not constitute any financial, legal, tax, investment, or other advice. Welcome to the Wealth Roundup for the week of September 10th, 2025 with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. We're getting into September. We've had a pretty good 3-month run here with the markets this year, haven't we?
Yeah, we really have. You know, after all of the pain and worry just prior to that kind of midpoint of the year, the markets have largely seemed unstoppable. And while over the summer, financial markets can get a little quiet, taking a bit of a summer break, now the pace really picks up coming into the end of the year.
Do you anticipate it's going to be a positive pace or a negative pace?
You know, on our last podcast, we were talking about how important the next 2 weeks are going to be, specifically with U.S. data. So we get a couple reads on U.S. inflation. We get a couple reads on jobs and job revisions, job number revisions. And then we get this critical interest rate decision by the Fed on the 17th. Right now, all stars are pointing towards a Fed rate cut. We're not quite sure on the magnitude, whether or not it'd be a quarter of a point or half a point. So let's just say probably the path of least resistance would be suggesting it'll probably be a quarter of a point. But some of the messaging, for people kind of, follow these, when people kind of break down and dissect the notes that come with the Fed decision, giving us some indication of what, to expect in the future. I think the new nuance that we're going to see with the comments is there's going to be more of a focus on U.S. job weakness as compared to concerns about inflation. And inflation, in my mind, is still the main consideration. But the U.S. jobless numbers has started to pick up. Obviously that kind of led to the termination of the head of the Department of Labor Statistics in the U.S. by the president. So new sheriff in town in that department, but then we've seen some job revision numbers, but certainly some job weakness picking up in the U.S. Here in Canada, we've been dealing with high unemployment. I think we've ticked up to 7.1% unemployment. Going back to your initial question, how do we think the markets are going to finish off? I think if we get this Fed rate cut, markets tend to like lower interest rates. I think this bodes well in general for financial instruments.
When you talk about the Fed, is it the equivalent of the BOC, the Bank of Canada, with the interest rates and how things adjust accordingly with inflation and jobless and all that?
Yeah, and they would both have the same mandate: overall health of the economy, looking at inflation, looking at jobs, primarily using short-term interest rates, the overnight rate as their primary mechanisms on the skid steer, which is these central bankers. They have other tools at their disposal with regards to foreign currency reserves and money supply, that type of thing. But it is primarily rates. I think it's a thing that people tend to focus on because of borrowing. An interesting fact that just came across my desk yesterday is that we have about a third of all outstanding Canadian mortgages coming due in the next 12 months. So the direction of interest rates and what either the Central Bank of Canada is thinking, or the Federal Reserve in the U.S., which hasn't cut rates yet this year, is really important.
Well, yeah, you consider what was happening 5 years ago, everybody started buying during the pandemic or just shortly after the pandemic, and you've got 5-year mortgages. The first is coming due, so that's a heavy condition. And of course, with the volatility of the interest rates, probably a good idea to talk to your mortgage broker and ask them about fixed or variable or what's in your best interest at this point. So did that kind of cover it? Like we were going to talk a little bit about mortgage rates and what they're expected to do here in Canada?
Yeah, so I'm going to kind of put myself out there that I don't actually think we're going to see a rate cut in Canada by the end of the year. And I think it's kind of 50-50. So I might be wrong on that. I think the concern here with the Bank of Canada acting too early is that if the Fed just starts and then we start cutting again, it really puts a lot of downward pressure on the loonie. We've already got inflation, which is kind of sticky, but we would say somewhat yeah, under control here in Canada. But that lower loonie would be lower purchasing power, which I think would kind of only feed inflation here in Canada. So my feeling, this is Patrick Leonard, not necessarily BMO Capital Markets, is that we probably see interest rate cuts in Canada next year and early in the year. And I think that that will be important because I don't see the jobless number in Canada improving anytime soon. Rate cuts for the US, which will help mortgages in the US and help borrowers in the US. Now mortgage rates tend to follow the 5-year bond rate in Canada. So even the belief that interest rate cuts in Canada are not too far away probably puts some downward pressure on mortgage rates, but certainly subtle over the kind of the last portion of the year, probably picking up some pace throughout the course of 2026.
Everybody is always looking for the next best thing or the next big thing as far as investments are concerned. And there is a lot to choose from, everything from old traditional investments to new cryptocurrencies and everything like that. Are banks a decent investment at this point?
We were talking about golf and talking about the old kind of wood shafts on golf clubs. Well, the banks are kind of been those old, dependable investments in Canada. The banks and energy companies, but the banks have always, people have always kind of looked at the banks and always kind of, in some ways, be kind of surprised at bank earnings of the past. Well, up until just like putting aside 2025, is that the banks have been not necessarily the best performing investment out there. There's been more perhaps excitement investing in the technology space. And because of the weakness in the Canadian economy, a bit of a hangover from COVID, is that the banks have been dealing with these high loan loss provisions. So they've had to put aside bank capital because of the expectations that repayment of loans, perhaps even bankruptcies and defaults on loans, the banks would have to basically make that up. And so how the banks do that is they set aside capital to address these shortfalls. And when the banks are having to set aside capital for that, that means that they can't set aside capital for going and growing their earnings. And so, the Canadian banks, are often considered to be a bellwether indicator of just the overall health of the Canadian economy. And so, what I find interesting is that in the last earnings results of the Canadian banks, kind of across the board, is that we didn't see a lot of growth in earnings per share, but we also didn't see them necessarily adding to their loan provision losses. They were kind of holding the line. And we've seen bank stock prices, here at BMO Nesbitt Burns or BMO Capital Markets, we don't cover our own bank stock, but if we look at the other big 5 Canadian banks, is that they've had a really good year. And, the bank index is up about 20% year to date, so slightly ahead of where the TSX is. So this kind of is a bit of a change of direction for the Canadian banks and perhaps a leading indicator that there's perhaps more positive news to come in the future. So, generally when we're looking at a good investment, we're looking at stability, perhaps a income or dividend, and then growth. And I think the thing that the banks have been over the last couple of years is they've been generally fairly stable. They've provided that really healthy dividend. And so if they can continue to earn more on interest that they're collecting on loans as compared to interest that they're paying out on deposits, then they can perhaps continue to provide this growth. I also think that aside from the banks, there's another important financial service sector out there that is often kind of forgotten, which is the insurance industry in Canada. Now, we often think about our insurance premiums going up, but the life cos in Canada, they've kind of trickled into doing a lot of the things that the Canadian banks have typically done, especially on the wealth management side. Whereas the banks often get a lot of attention, the big insurers like Manulife, Power Financial Corp, Sun Life, Industrial Alliance, these other very large Canadian institutions which have become very global. Manulife's business outside of Canada is quite significant. For the most part, kind of trading at prices relatively a little bit lower than the banks. And so there are some other investment themes out there besides crypto, besides, the Mag 7 that typically here in Canada we do really, really well and which have recently showing some life.
Very good. The Wealth Roundup for the week of September 10th, 2025. Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. Thanks, Patrick. Have a great week.
Yeah, you too, Terry.
This has been the Wealth Roundup with Patrick Leonard from the Leonard Wealth Advisory Group of BMO Nesbitt Burns. I'm Terry Evans. The Wealth Roundup is part of the Reluctantly Podcast Network.